For a long, long time, the most powerful investment tools were, locked away. They were just for big institutions and the super rich. But that's all changing, and it's changing fast. The entire game is shifting, and a whole new toolbox is opening up for everyday investors. So let's crack it open and see what we've got.
And that really is the question, isn't it? I mean, for years, these giant firms only cared about massive pension funds and endowments. So why the sudden pivot? Why do they care about the individual investor now? Well, the answer has to do with one of the single biggest economic shifts happening in our lifetime.
You see that number? $84 trillion. That is the mind-boggling size of what's called the Great Wealth Transfer. Over the next couple of decades, that much money is going to move from baby boomers to younger generations. And this new wave of investors, which probably includes you, they don't want the same old cookie-cutter products. They're demanding way more control, more personalization. So here's what we're going to do. First, we'll talk about why the old toolbox just isn't cutting it anymore. Then, we're going to unpack two really powerful new tools. One that's like a sledgehammer for breaking into private markets, and another that's like a laser cutter for building custom portfolios. We'll compare them head to head, and then we'll wrap up by looking at what all this really means for the future of investing.
Okay, so to really get why these new tools are such a big deal, we first have to understand the limits of the old ones. For most of us, investing has always meant one thing: buying stocks and ETFs, the public markets. But that world, it's not what it used to be.
This might actually surprise you, but the number of public companies you can invest in has been shrinking a lot. Back at its peak, there were more than 7,500 companies listed on U.S. exchanges. By 2017, that number was nearly cut in half. Fewer companies just means fewer options for us in the public market.
And this right here is the perfect way to think about it. The public pond is getting smaller and more concentrated, but at the same time, this massive, booming private ocean has emerged. Get this, 86% of companies with over $250 million in revenue are private. That is a huge ocean of opportunity that most people just couldn't get to. So the big question is, how do you get into that private ocean? Well, let's grab our first tool. I like to think of this one as a sledgehammer. It's big, it's powerful, and it's designed to do one thing: smash down the walls between the public and private markets. Now, the term alternatives can sound kind of complicated, but the main types are actually pretty easy to grasp. Private equity is just owning a piece of a company before it goes public. So think about being an early investor in a company like Uber or Airbnb, way before you could ever buy it on the stock market. Private credit is basically you acting as the bank, lending money to businesses. And private real estate lets you own a piece of big commercial properties, like office buildings or apartment complexes.
So, why would you even bother with all this? Well, check out the returns. Between 2007 and 2023, private companies delivered average returns of 12% a year. That blew away the 7% from public companies. That potential to capture a company's really explosive growth before it IPOs, that is the big appeal.
Okay, this all sounds pretty great, right? Higher returns, getting in early, but there's always been a catch. For decades, there's been a gatekeeper standing in the way for most people. And that gatekeeper has a name: the accredited investor. It's a legal status, really. It was created way back after the Great Depression, believe it or not, as a way to protect people. The idea was that these private deals are riskier and less regulated, so you needed to be sure the people investing in them could handle the potential loss. And the bar to qualify is pretty high. You usually have to meet one of these rules: either a net worth over $1 million, not counting your house, or a consistently high income for the past 2 years. Or you need to hold certain professional finance licenses. So if you meet these criteria, this sledgehammer tool is one you can potentially add to your toolbox. All right, let's put the sledgehammer down and pick up our second tool. And this one is completely different. If alternatives are about brute force, breaking into new areas, then this next tool, direct indexing, is like a laser cutter. It is all about precision, control, and customization. For as long as I can remember, if you wanted to track, say, the S&P 500, you just bought a single fund, an ETF or a mutual fund. But what if you could kind of unbundle that fund and build your very own version of it from the ground up, one stock at a time? Well, that's exactly what this is all about. So what is direct indexing exactly? It means instead of owning one share of an S&P 500 ETF, your brokerage account literally holds all 500 of the individual stocks that make up the index. And owning the stocks directly, that's the secret sauce. That's what unlocks all the cool stuff you can do.
And hey, if you're wondering if this is a big deal, just follow the money. Since 2020, you've seen an absolute arms race among the biggest names in finance. Morgan Stanley, BlackRock, Vanguard, they've all been spending billions to buy up direct indexing companies. They know that this level of personalization is the future.
So why all the excitement? It really comes down to two huge benefits. First, it's a game changer for taxes. Because you own the individual stocks, you can sell the ones that are down to generate a loss, which you can then use to cancel out gains elsewhere in your portfolio. It's a powerful strategy called tax loss harvesting. And second, personalization. You can tell it, hey, I don't want to own any tobacco stocks, or I already own too much of my company's stock, so exclude that one. You get to fine-tune it to match your exact preferences.
Okay, so we've got the sledgehammer for power and the laser cutter for precision. Two very different, very powerful tools. But how do they actually stack up against each other? And more importantly, how do they compare to the tool we all know and love, the good old traditional ETF? Let's put them head to head. This table really tells the whole story. It's all about trade-offs. Your traditional ETF, that's your reliable workhorse. It's simple, it's dirt cheap, and anyone can buy it. All the way on the other end, you have the alternative fund. It's built for one thing, chasing high returns. But it comes with high fees, your money is often locked up for years, and it's mostly for accredited investors. Direct indexing carves out this really interesting space in the middle. It's not trying to be the cheapest. Its whole purpose is to give you control, for taxes and for personalization, and it's getting more and more accessible every day.
But that laser cutter precision comes with one specific risk you absolutely need to know about. It's called tracking error. Think of it like this. If you're following a GPS route, the more you decide to take your own custom detours, the more your arrival time is going to be different from what the GPS first told you. It's the exact same idea here.
And this is not a small thing. Look at this chart. A seemingly tiny 2% tracking error can lead to massively different results over the long run. The more you customize, the more your personal portfolio could either crush the index or seriously lag behind it. That is the fundamental trade-off you make for all that control. So, after digging into all these new tools, what's the big takeaway? Well, it's pretty clear the future of investing isn't going to be about just picking some product off a shelf. It's going to be about building your own blueprint.
When you boil it all down, we're moving from the financial version of a one-size-fits-all t-shirt to a custom-tailored suit. Whether that means getting access to private markets with a sledgehammer or fine-tuning your public portfolio with a laser cutter, the entire industry is moving toward giving you more power and more choice to build something that is uniquely yours.
So your toolbox is getting bigger, it's getting more powerful. The old walls are coming down, which means the only question left, and it's the most important one, is which of these tools are you going to use to build your future?